Alright, so I hope everyone's doing well. So anyways, I wanted to sorry, just get started on something. I've actually been thinking about recently trading more of the spider and more ETFs, and one reason is, number one, I've never really done it. I like the E-mini, and I'll probably, I do like it, but also I've been I want to get some options, and I want to start kind of quote unquote messing or trying out some options and just kind of get some experience with that. But so anyways, one reason I'm pulling out the spider chart is it really is a great chart. It's a great market to trade for anybody. And one of the reasons I like ETFs and Forex markets is just because it's so easy to, you have so many choices in terms of sizing. And one of the biggest things, by far the most important thing to me starting out, is minimizing your risk. And when I say minimizing your risk, trading small, the ability to trade small where you really don't care how much you're risking. I think that is just extremely important. The ability to trade the quote unquote I don't care size that Al talks about. Next, trade management. Anybody that's traded the futures markets or something like E-mini, they all realize that everything's really big, so it's easy to, you kind of have less leeway, especially when you're starting out. So I just figured, hey, I'll venture somewhat into the spider. I've always liked it, and I still like the E-mini a lot. There's no, I'm not saying I'll never, I'm not going to trade the E-mini anymore. That's not at all what I'm saying. I'm just, I want to enlighten. I want to trade more options, but I also want to, I want to, just look at the SPY for a little bit, just kind of trade that for a little bit, just kind of get used to it. And, personally, there's other markets I want to trade, ETF wise, and take some longer term trades, such daily trades or 60-minute, 30-minute trades. And to me, the easiest way to do that is with stocks. So anyways, I just want to look at, say, this is the spider, the SPY. It's it's the ETF of the S&P 500 or the futures market. And I just want to kind of show some examples of this market, just kind of show how it's not all that different. So let's start out with this. The E-mini. Here's the E-mini. I mean, just take a look at this. With the spider, minimum scalp's 10 cents. That's roughly 1 point in a minute. And just to show you how accurate both are, look right here. This bar, buying above this bar, was a 9-tick failure for the bulls. That means the bulls tried to go for 2 points and they needed one more tick to get out. So look what happened. Their entry was $28.50. Price went to $29. Sorry, I got a little mixed up. But yeah, it went 1 point. So $28.50 was $28.75 was their entry. Price went to $29.75, and the bulls needed one more tick to scalp out with 1 point. Let's look at the spider. Same thing happened. And the spider, yeah. So if you buy above here, your entry is $214.14. So in other words, $14.14, however you want to say it. And price needed to get to 20. Excuse me, it's just kind of weird saying it out loud. 214.25 to scalp out with one, quote unquote, a minimum scalp, or similar to 1 point. And you can see price wants 24. So one of the big advantages to trading, I firmly believe in giving yourself as best as an advantage when it comes to starting out as you can. And I just think that the easier you can make it on yourself, the better your odds are of becoming successful at this. And one of the great things about Forex, or if you're willing to put in the amount for these equity accounts or ETFs, is you can truly trade as small as you want. For example, I think if I had to say, if you take one contract in the E-mini, it's $50 a point. Take something like the Spider or an ETF. That's roughly, if you trade 100 shares, that's about 1/5 of an E-mini contract. And the reason I say that with the Spider is because if you think about it, if you're trading 500 shares of the Spider and you go for 10 cents, that's $50. So if you go for 10 cents trading 100 shares, that's $10. So it's a fifth of that. So, just one of the advantages is, going back, if I could go back a few years, the one thing I would do is I would take the Spider or a Forex account. If I didn't want to put the $25,000 in an ETF account, I would go to immediately Forex. And but I'm just gonna use the Spider for now. What I would do is I would just trade 100 shares, as small as I could trade, maybe 50 shares, but that probably I think 100's fine. And I would just trade, and I would say, okay, short below, put your stop up here. Maybe you wait till here, you sell this close, and if you look, it's about 14.32 to 15.17. So what? I'll just get around 80 ticks. I'm not gonna do the actual math. So let's say it's 80 ticks, just for argument's sake. Well, in the E-mini itself, you sell this close at 30.75, you put your stop at 39.25. That's about 9.25 points. That's over $450 a contract of risk. And that certainly makes trading difficult for traders starting out. Well, if you're trading the Spider, you're trading 100 shares, you're risking less than $100, and are you really going to you'd have to let price go all the way up here to stop you out. And if you wanted, you could say, okay, I'll sell this close, I'll take part off at 2 times my actual risk. Maybe you take part off 20 cents if it just goes your way. Okay, so that would be, if you sold this close at 214.32, you'd get out at 214 and 2 cents. Like what happened, and it turned up after that, and then you could just, however you want to do it. Maybe you want to say, okay, probably 60% chance of measure move down. I will, or maybe you look at this point and say, okay, I'm going to use this, maybe 60% of this measure move down. So what I'll do is I'll sell, I'll take part off somewhere down here, maybe above this bar, or all off. Either way, there's so many choices, and it's just so much easier when you can trade keeping your dollars fully at the same risk. And I invite you, just look at, I've looked at tick charts, I've looked at all sorts of charts of the Spider compared to the E-mini, and it's identical. I'm looking at, I remember Monday pretty well. I'm forgetting that I'm even looking at the Spider, because I keep thinking about the E-mini. And if I just look at it, here's a 60-minute chart. You're having a little bit of internet difficulties or something, but sorry about that. Yeah, so here's a 60-minute chart. It looks really similar to chart from the other day. I mean, obviously, I guess one difference would be the fact that we've closed the gap on the Spider I guess that's a little different. I don't know why, but my daily charts aren't working. But anyways, let me just review the day real quick. So, open up today, very close to the prior day's low. And again, this is just the spider. Very close to the prior day's low. We're bouncing up above. I would not buy above this bar. It's big risk, and it's really, I think it's more of a scalp. In other words, it's bulls buying down here and taking profits out on the bounce. Bar 3, decent short. If I had to do anything, buy or sell below bar 3, arguably low too short. I would sell below it, probably always in the short below it. Clearly always in short on this close or this close. But like I said, big risk. So if you're trading the spider, it's much easier to sell and put up here. And another advantage is, let's say you're starting out and you only want to take second entry shorts and a clear trend. Well, or maybe second entry shorts at the moving average. Well, one way to go about that is, instead of waiting and waiting and waiting and missing this entire move and maybe selling here at a pullback, you say, okay, clearly always in short, I'm going to trade immediately. Just cut your position down, size down to 1/4. So if you trade 500 shares, so in other words, that's kind of like one E-mini contract. If you're trading 500 contracts, 500 shares in the spider, not 500 contracts. That would be an insane amount in E-mini. If you're trading 500 shares, just immediately trade 100. Just sell them, put your stop up here, and just get short and just hold until it's clearly not always in short, or until it makes sense to get out. And you won't get, obviously, you're not going to get really rich doing that, but it's always better to have something on the trade than nothing. So another example, the ability to trade small. Anyways, clearly always in short. First will probably fail. If you're looking at these, they're only going up, a point. They're only getting, basically. And just to be clear, because I'm gonna do this many times, just not thinking. If I'm ever looking at the spider, you'll see it up here, SPY, instead of the E-mini, which would be at es.d, at es, or es, the contract, so es, in this case ESZ16. If I'm ever looking at the spider and I say, bulls only made a 1 point scalp, I'm not thinking about it, but I'm referring to a 10 cent or 10 tick scalp. In other words, you can see if you bought above, you were filled at 214.1 and price went to, I'm sorry, you were filled at 213.91 and price went up to, easily enough to scalp out for 10 cents, which is the minimum scalp. But when the bars are really big like this, minimum scalp's probably 2 points, and you can see right here, the bulls needed a 2014.22 for, make sure I'm looking at this right. It's kind of, yeah, see, again, I'm not used to thinking in scalps with the spider, so it's going to take a little bit of time to get used to. They need 2014.12, and they clearly got it. So finally, the bulls made 1 point scalp. It's around the 50% measured move. Well, I say that it's not really close to 50. That's interesting. So on the E-mini, the price came closer to a measured move. Guess it really didn't. But yeah. So anyways, and this is where I thought, this had a. You can make the argument, disappointing. I think this is where the bears tried to make the move stronger and they failed. Usually when you get something like this, first up will fail and then you start to go sideways. But this is a lot of bars sideways. Many always in bears will get out above this bar, but if they do, they got to get short again. Do they get out? Do they get short below here? No, I think bulls, if an always in bull got, they buy, they definitely sell again. They definitely sell out of longs up there. Bears, they either short here, short this close, sell above. And then, probably a broad channel or, early stages of a trading range. So I think a lot of bulls will get out above this bar. If not on this close, arguably always in long by maybe this bar, probably this bar. But again, I think bulls would not buy below here, but I certainly think they would get out below this bar and maybe short. But it never clearly became always in short. If you sell below here, you're betting on a higher low major trend reversal. So bear trend, kind of you call it expanding triangle if you want. So bear trend line break to a new low, and another trend line break of arguably kind of like that, and a higher low. You can also call it a head and shoulders double bottom or head and shoulder bottom, where you have a left shoulder. It's basically you have a trend line break, lower low to a higher low that forms a double bottom, but really when that clearing we end up going sideways. If you sell here, you need, when you start to see this, you got to be taking higher low and probably more sideways, and we'll probably test up these closes. And of course here 85, 87. So bulls, they buy this close. If they're quick and disappointed, they get out or break even. Otherwise, they buy more and they scalp out. Really not a lot to say. I guess the main thing is just about if you have the ability to trade small, or the ability to trade the ETFs and be able to provide the minimum account balance, then to be a day trader or a pattern day trader, whatever it's called, I would consider it a lot, because the thing is, you don't think of it in terms of oh my gosh, if I'm only trading 100 shares, I'm only making $100 or $50 or $70. Think of it as in terms of you're getting to practice with real money. It's kind of like you're getting to test, you're getting to put your toes in the water and not diving in head first, so to speak. But and I'll start talking more about options. That's kind of the one reason why I'm starting to look more at ETFs. But again, the reason I'm going to be talking more about ETFs in the first place is I just want to show that they're the same. They act the same logic's going on. I just want to show that. So again, I'll be talking more about it. And like I said, if you're starting out, I'd consider trying to trade an ETF, because if you trade the spider, again, if you buy here at, we'll say 13.31, you stop slowly down here at 13. I'm sorry, at 12.31. That's almost, if I had to guess, that's going to be, let's just see, close to 10 points in the mini. So this low is 10.50. This high is 27.5. Yeah, that's more than 10 points. So if you're starting out, that's difficult to do. That's a lot, You're going to be more likely than not uncomfortable if price had a deep pullback. But if you're trading the spider, once again, you buy here, put your stop down here, you're risking $1. If you're trading 100 shares, you're risking $100. You're risking a fifth of what you would be risking. And if you want to take it a step further, you buy here, you buy more down here, you take part off, and you trail. So you got many choices. And traditional, here's one approach. I know Al has a friend that does this. Maybe you say, okay, I'll buy here, I'll take part off up here, another half off up here. If you did that, you did pretty well. So just something to think about. All right, post any comments below if you have any questions, and thanks for watching.